When that brings down a payment $1,000 or lowers your 30-year rate by 2 points, that is really significant. And you can see that that's a total game changer for people. Hello, everyone, and welcome to another Mortgage Minute. I am Matt Thomas. I'm a local realtor. I'm joined today by the president of Maverick Lending, Brian Daywald. And Brian is a very tenured loan officer. Brian, as always, we talk about how rates and mortgages impact the real estate purchase world. Obviously, we've got some things going on in the news with the government shutdown that impacts rates, but we've seen rates generally be in pretty good shape relative to the last year or so. You want to tell us what's going on with rates?
Yeah, so looking at current stuff, and then let's also talk a little bit about forecasting and looking at some ideas there. So the last 3 weeks in our world has been very, very quiet. So a lot of that has to do with the government shutdown. When we look at data for the mortgage world in terms of prices, right? When we look at prices, we're talking about rates. Higher the price, the higher the mortgage rate goes. So a lot of the data that generates mortgage bond prices is sensitive, and we're looking at government data. So employment is a huge one, as we've talked about a lot, right? And most of that data comes from an entity called BLS, which is Bureau of Labor Statistics. And since the government shut down, we don't get any of the activity. So anyway, that's kind of what we're seeing lately, is a lot of information that's just been kind of shut down. We are seeing a little bit of movement, but there's some outside sources, whether it's commentary from Powell, we'll talk about that coming up shortly. I've seen a couple things from like Japanese trade markets, and these things that don't usually have much of an impact in our world are kind of causing a little bit of shift. And when I say a little bit of shift, we're talking, 10 or 15 basis points over the last 3 weeks of movement total, which is a very, very small amount when we look at that big of a stretch. In fact, I'll pull up a quick screen share here and kind of show you over the last 3 weeks. So this is what we call a candlestick graph. So this is the last, going back almost a month here, September 17th, 18th. Red means we're losing price. That means rates are going higher. Green means rates are getting better. So, and it looks like a lot of up and down, but it's only a small amount here. If I show you what a 6-month window looks like, you can see a lot more up and down movement here. So what I showed you here, if you can kind of see my cursor here towards the right, that's a pretty flat line over the last, like I said, 3 weeks or so. So anyway, relatively good news, because at the beginning of this stage, rates had been, at a X amount low, right? I can't remember how long it's been, 12 months or 18 months or something. So we've had
they were actually the lowest in 3 years. And now we're seeing them in kind of hovering in that 6.25 range, which is pretty favorable for, in comparison to the last several years.
Yep. Yeah. So that's a little bit of a look back over rates over the last, 2-3 weeks. Moving forward, we got a little bit of data yesterday based on a conversation that happened on Tuesday of this week. So today's Thursday, the 16th. On Tuesday, the 14th, Jerome Powell was speaking about doing some runoff in terms of, Fed shares and things like that. And that had a little bit of positive movement in our world, but it's also sort of forecasting, potentially some lower rates. So, if they start to do some of this easing that they're talking about in this runoffs, it could send the 10-year treasury into the threes, which is what we're hoping for, right? Maybe 380 or 360, maybe even perhaps. We're kind of teetering right around that 4.0 mark the last few days, which has been great. So, fingers crossed that we'll start to see some better interest rates for buyers. The other thing that's been impactful, and we're starting to see a little bit more of, these are just really small little bites of the apple, it seems like, each day, but they'll all add up at some point. We talked last time about the spread, right, between a 30-year fixed rate and the 10-year treasury, and that averages lifetime somewhere between 1.5% and 2%, and it's starting to shrink a little bit. Right now, it's about 2.2. So if Fed rates, if the 10-year treasury continues to fall a little bit, and the gap between the 10-year treasury and the 30-year fixed shrinks, we could see rates somewhere in the 5s potentially. We'll cross our fingers that we get there. But anyway, the outlook for rates is positive at the moment.
Ultimately, that trend of will bring down mortgage costs, right? So that's exactly what we're looking for sure. That spread narrows, and we end up with cheaper closing costs, which would be fantastic ultimately. Brian, let's shift gears a little bit. One of the things that I'd love to talk to you about is just how folks are maneuvering in this market. Let's kind of look at some opportunities, and we're going to call it Opportunity Spotlight. I'd like to bring to everyone's attention a product that I think is helping folks right now kind of navigate this market. Why don't you tell us about what you had in mind?
Yeah, so I partnered up with a group a while back that allows us to look at a really cool bridge loan product. And this doesn't work for everybody. You've got to have some equity in the home. You've got to be motivated to sell when the time is right. But it's a really cool way to fast forward some of the equity out of your current place to make a down payment on your new house. Like I said, this isn't for everybody. There's some restrictions just in terms of what you're selling your house for. I believe the cap is $1.5 million. We've got to do a regular conventional loan for the new place, but it's really unique because there's a flat fee to use the program, but there's 0% interest and there's no payments. It's all taken out of the bridge loan. So it's a really cool way to buy a new house while feeling like you've only got payments on the new house. So we've got 3 or 4 of them going at the moment. Kind of the strategy is let's buy when it's a buyer's market, and then let's consider putting the house on the market maybe after the first of the year once things traditionally speed up for sellers a little bit. So having a lot of success with that program at the moment. And particularly for folks that want to get into a certain neighborhood or a certain floor plan or a certain school district, waiting for the one to kind of come up. This is a really great program for that.
That's great. How long do people have to sell once they enter into a bridge loan scenario?
Great question. 6 months.
6 months. Okay. Pretty typical. Well, that's good.
Yep. Yeah.
Yeah, fantastic. And that's great to see that that's actually helping people, make that transition that they might have otherwise found difficult to make or may not have seen the vision for, or the possibilities for, given the current market scenario. So that's great. Brian, you mentioned also you've got another real life scenario that kind of shows the difference between a price reduction and concessions. We talk about this a lot because that is one of the big advantages in this market that people are taking advantage of. And I'd like to have you kind of go through that if you would.
Yeah, so we'll kind of touch on some of the basics, and you and I have talked about this quite a bit. But one of the the biggest challenges right now for folks that are looking to buy a house is just the affordability, right? When I think of affordability, it's just the payment, right? With rates and inflation and everything else there. So what I've tried to do is just show people how effective the interest rate is, and how much it matters when it comes to your mortgage payment, especially when we look at the relationship between a price reduction and what that looks like. So I just had some folks go under contract yesterday that we strategized the scenario. These rates are probably a little higher than what we would normally see because they've got some credit challenges, but nonetheless, it works whether it's perfect credit. It works if it's 1% or 5% in terms of reduction and concessions and things. But I have an actual scenario. This is the one that we put under contract yesterday, and I'll go through and explain some of this math to you here real quick. Let me go back to my screen share here, and we'll pull this up. So the asking price on this particular house is $1,023,000. We were doing a max financing regular conventional loan, which is at $819 at the moment. And like I said, they had some credit challenges. So the out of the box rate for them was at 7.125%, with a 7.3 APR. So that yielded on this particular property with taxes and stuff about $6,700 a month, as far as a payment goes. If we were just to reduce the price by, I believe it's about 4%, we can see here kind of in the middle right section, it's about a $300 a month savings in payment just to get the house for cheaper, but using the same loan terms. In this middle column, we take the same sales price as the first column, and instead of taking the reduction in sales price, we do the same dollar amount to give us a considerably lower interest rate. In this, we can kind of see here, I don't think this will highlight for me. Here are the 2 payment savings. So by buying the house for a 4 or 4.5% discount, we save about $300 a month. But using it to get the interest rate lower, it's over $1,000 a month. So
Wow.
Really taking a deep dive into looking at those figures, that's where all of this affordability comes into play. And like I said, the math is always similar. Meaning, if it's a $500,000 sales price with a 1% discount, no matter how we use that, it's always going to be more favorable to go this route, to use it for concessions, than it is to, get a discount on the house. The other thing I'll mention too is that, at one point in the last couple of years, it got really, really popular to look at what's called a temporary rate buy down, right? A 1.0 buy down or a 2.1 buy down or a 3.21 buy down. And at the beginning, they were great. But everybody that took one of those out at this point, they were thinking that rates were going to tumble, back to where they were, which if they had a bad loan officer, that's what they were told. But, the folks that did a 2-1 buy down 2 years ago are right back up to where they were when they started. So it's not a great program, in my opinion. What I'm showing here is a full on, 30-year fixed. It's not a temporary buy down, in other words. So
I was going to ask you that's for a 30-year fixed scenario. So once you move that from what you in that scenario was 7.125, and then it bumped down to just under 6.
It went from 7.125 to 5.125, 2 points difference.
5.125.
Yep, and that's where we see that math, right? And that was a bigger scenario, right? That's on an $819,000 loan. So we're not going to get the same impact on a $500,000 loan, and we're not going to get the same impact if we only get 1% or 2%. But regardless of the math, it's always going to be in our favor from a monthly payment standpoint to use the discount from the seller and concessions that it is just to get a cheaper house.
Well, and there's all kinds of speculation as to just how low rates would need to get the masses off the fence, right? We've got people,
right,
that are in a position to take advantage of opportunities in this market now, but obviously there are a lot of people that are still hesitant. When you see the difference in affordability, because that's really, it seems like in most cases, everyone's challenge right now is the affordability piece. When that brings down a payment $1,000 or lowers your 30-year rate by 2 points, that is really significant. And you can see that that's a total game changer for people. So that's awesome. I mean, again, these are real life scenarios. With the bridge loan that you said, you've got 3 people under contract working with that right now, and some folks that just rent. This is their scenario that that they're going through right now. These are really fantastic opportunities to kind of skirt the market condition. I don't know what you want to call it, but certainly just find the opportunities. Where it looks like people are otherwise thinking or assuming that there's roadblocks.
Right.
That's awesome.
Agree. Yeah.
Well, and that's ultimately our goal of this is to help you understand what drives market rates, what drives market conditions, what the market conditions are, and then how we are solving these problems with our clients. So, Brian, these are great scenarios. I appreciate the insights, and as always, I guess we'll look forward to connecting with you again soon.
Looks great.
Awesome.
Sounds great. Whatever that word is.
Okay.
Sounds great. Thanks for having me. See ya.
All right. We'll catch you later.